Hello guys, and welcome back to the MD Investor channel where we're talking about personal finance, setting goals, achieving goals, breaking the cycle of generational poverty. We talk about increasing our financial IQ so we can do better than our parents and our grandparents. Talking about increasing the financial intelligence of our children by getting motivated, by getting educated, and taking action. If there's people out there you think could benefit from this information, definitely send them a link, pass it on. But most importantly, make sure you hit that subscription button, okay? Make sure you hit that subscription button and so you'll be notified when new content comes out, okay? So new video, guys. Today we're gonna talk about the stock market decline. As you know, over the last week or so, the stock market has dramatically declined, about probably 10% drop from the peak, mainly from coronavirus fears. The coronavirus started out in China, but as we know, it's been spread now to other countries, and now it's hit the mainland in the U.S. It's in the U.S. now. I think the first documented person with the virus, not related to contact with someone who's traveled to mainland China, has been reported in California. There are a lot of people out there now on a quarantine. So because of the uncertainty in the market, because of the fears, and also because a lot of companies have warehouses and do a lot of business in China, the market is reacting. And the market does not like uncertainty. And that's basically what's going on right now. We talked about it earlier, right? We said that the stock market always pretty much goes up. But that's the overarching theme, or that's the 10,000 feet view. In this going up, there are little dips and little blips, and that's what we're experiencing now. Stock market correction, the definition is a 10%, at least a 10% drop. That's what we're in. We're in a correction right now, right? We're in a correction right now, and it's all because of the fear. It's not the first time, and it won't be the last time. Remember 2008? Right? Same thing happened. 2008, markets dropped, right? And what happened? Markets recovered, right? And here, again, it's going to be the same thing. So the market is dropping, but we know that it's going to recover. And in the meantime, we need to just hold on, right? We need to just hold on because we know it will recover. So let's look back at 2008 and a little personal disclosure here. 2008, when the markets were going down, it was about 12 years ago, markets were going down, so my portfolio drop in value, and after a little while, I said, okay, I can't take this no more. I'm gonna sell, which was the worst thing I could have done. Sold it. In addition, in a retirement account, so in addition to the taxes that you have to pay for taking it out, and you're under 59.5. Also, I sold at the bottom, right? Number one rule in stock market investing is you buy low, sell high. You don't sell at the bottom. Because just remember, guys, everything is basically on paper. It's called what they call paper losses. Until you sell, it's paper losses. Whenever you look at your statement, right, from your retirement account, whatever, you'll see something called unrealized gains and unrealized losses. All that means is that it's basically just on paper. Example: if you bought a stock for $100 and the stock went up in value to now it's $200, right? You have made $100 on paper, right? You have no money. You don't have $100 extra. You bought it for $100. The stock went up in value to $200. So you've gained $100. But it's unrealized gain. Why is it unrealized? Because until you sell it, you don't have the money. That's what they call paper gains or paper losses. The opposite, you bought a stock for $100 and now it dropped in value to $50. You've lost $50 on paper. That's an unrealized loss. when you watch these people on CNBC and Fox News, they'll say, well, after you sell, if you sell at the bottom, now you have locked in your losses. What do you mean? You had that one share. It was $100, and now it's down to $50. But it's on paper, right? Because you still own one share. When you sell it at $50, you'll get your $50, but you don't have one share anymore. Now you've really lost $50 because you had to give $100 to buy the share. And now when you sold it at $50, all you have is $50. You have lost $50. Now that's realized loss. And you've lost the share because you don't have that share anymore. So when that share price begins to go back up, you won't be along for the ride upwards because you sold. And so it is, right? So let's go back to our analogy. You have one share at $100. The price is cut to $50. You still own one share. If you just hold it, and when it goes back upwards to say past $100, $250, you can enjoy the ride on the way up, the stock market ride, the appreciation of the share. When you sell it, then is when you lost it, okay? So just remember, it's all paper losses until you sell. That's a mistake I made, and a lot of people made in 2008. You may say, oh, that sounds so simple. It sounds simple on paper, but in reality, it's very emotional. Let's use some real numbers now. Let's say, for example, someone has a portfolio of $1.2 million, right? They've been working, they've been contributing, right, from age 20 to age 25, and they've been contributing, and they've been getting the compound interest, and, the rule of 72, and their money has been doubling every 7 years and so on, and they have a $1.2 million portfolio. Okay? Stock market drops. We're in a correction. Stock market drops. Their $1.2 million portfolio goes down to $1 million. Okay, all right. I'm going to hold on. Stock market keeps dropping. Because that's a key to remember too. No one knows where the bottom. That's why it's hard to time the market. No one knows where the bottom. Because people would like to buy at the bottom. Because that's where the cheaper prices are. They like to get in and buy. But you don't know, right? If we knew the bottom of the lot, people would be geniuses. You don't know. You buy a stock for $100, and then the next day it dropped to $80. So, oh man, should have waited. I could have got it for $80. And then the person who buys it at $80, and the next day it drops to $60. Oh, I should have waited. But nobody knows. Should I buy here? Is it going to go back up, or is it going to continue to fall down to 40? You don't know. Back to the example. So $1.2 million portfolio, market correction, your portfolio drops to $1 million. You said, okay, I'm going to hold on. I know all markets eventually rise. Your $1 million now drops to $750,000. So you've seen your portfolio go from 1.2 million, now you're at 750,000. I'm gonna hold on. Your 1.2 million portfolio now is 600,000. Your portfolio has been cut in half. 600,000. It takes the steel spine, supreme confidence, strong backbone to not sell at this point, to stop the hemorrhage, to stop the bleeding. Your $1.2 million portfolio is now $600,000. What do? You still have the same number of shares. So if you had 10,000 shares, you still have 10,000 shares. They're just value that's worth half. Your $600,000 portfolio is dropping, and now it's only worth $400,000. You still have the same number of shares, but now it's cut to $400,000. Your portfolio has been cut into a third. Do I cut my losses? See, that is the reality. It's easy to say, oh man, all markets go up, just hold on, or buy at the bottom. You're getting them on sale. That is true, but it's very emotional. It's very hard to really do, right? Maybe if someone is 20 years old, they'll say, oh, I have my whole life to wait for the rebound. But what if you're 63 years old, 64 years old, 65 years old, 68 years old, and you're thinking about retiring now? Right? You hate to sell. Because when somebody retires and living off their portfolio, they're basically selling off assets, right? They're selling off assets, selling off stocks. You hate to sell in a down market, right? Where the prices are low. You hate to sell in that type of condition. So back to our example, your $1.2 million portfolio is now cut to $400,000. We know all markets eventually rise. Within 2 years, usually the market begins to correct and go back up. But when you're in it, it's very emotional. Part of you want to say, to stop the bleeding, I'm going to cut and run right now before it gets any worse. But your brain says, yeah, it's going to go back up. But your heart says, I can't take this anymore. That's why you have to know your risk tolerance. That's why you have to be diversified. That's another video. But so this is the emotional aspect of investing. Okay? But we're going to look at it on the positive side. Stocks are for sale. I've done videos where I say, when everything else is on sale, right? If your Apple phone or your MacBook computer's on sale, or your favorite sneakers, TV, your vacation spot, your hotel room, everybody's happy. Great sale. I got a great deal. But when it comes to the stock market, everybody freaks out. What I'm doing right now is what they say, back the truck up. Back up the truck and load up as much as you can. Because eventually, once they find get the antibiotic or antiviral treatment, medication, vaccine, and everything calms down and the fears go away, the prices are going to go back up and you're going to miss it. But with this an opportunity, I'm using this as an opportunity to buy great companies that fundamentally there's really nothing changed, but because of the fear and the uncertainty out there in the market, they're on sale. The whole market is on sale right now, right? Companies like Apple are down. Everything is, 52-week low. 52-week low. Opportunities, right? Home Depot, down 5%. A company like Boeing was trading in the mid 300, 360, 370. Now it's about $270. It's 52-week low. Opportunities like this doesn't come along. I know Boeing has other problems, but even the problem with the IMAX 737 didn't really cause the price to drop that much. But coronavirus is doing it. Carnival Cruise Line was trading about $50. Now it's about $35. So you see, this is what I'm talking about. So the entire market is being hit, but definitely travel and leisure stocks are being hit hardest. Nobody wants to go anywhere, right? So just remember, guys, market always goes up. They always recover. They go upward and to the right. And we're just in a correction right now. And we've had them before, and we're going to have them again. And use this as a buying opportunity, okay? Use it as great companies are on sale, and you wouldn't have this opportunity. So if you can manage it to get more money in the market, I would highly recommend it. That's what I'm doing. I'm getting money in the market because I know that this opportunity is a buying opportunity. So there's a quick video, guys, just to put your guys' mind to rest, to reassure you guys the market is going to go up. We're going to continue to buy on the way down, okay? Because what you're doing, think about it. Stocks that were $100 are now, say, $75. You can get more for less. You can build up your position, guys, because eventually what's going to happen, you're going to recover, and then the prices are going to go up, okay? $1,000 is not going to buy as much as it used to. So I'm using this as a buying opportunity. You should also use this as a buying opportunity. So again, that's a quick video, guys, to keep the fire burning and to motivate you guys that use this as an opportunity. Of course, we feel sad for people who are affected by this medical condition, but as investors, we have to see this for what it is, an opportunity, what they call an entry point. So continue to be motivated, continue to educate yourself, and continue to take action. And let's continue to back the truck up and buy as much as you can. This is the MD Investor. If there's people out there you think could benefit from this information, let them know about the MD Investor, and continue to subscribe, continue to leave comments, and continue to take action. And I will see you on the next one.